Hello, everyone. Welcome to the Wharton Global High School Investment Competition Meet the Experts series. I'm Eli Lesser, Executive Director of the Wharton Global Youth Program. Here at Wharton Global Youth, we use the opportunities of the Wharton academic community to educate, inform, and inspire pre-collegiate students to explore business and finance in meaningful ways and become leaders who will transform the global economy. One of the things that makes our community so great is that it truly reaches students and their teachers and advisors around the globe. Before we get started with our conversation today, as usual, if you've tuned in before, we'd love to know where you're connecting from. Please use the chat channel here in the Blue Jeans system to tell us where you're connecting from. We'd love to know. Give us your city, state, country, wherever it is you're connecting from today. Tell us where you are. We'd love to see where you're coming from. So just put it right there in the chat. All right, we will watch those come in. So today you're joining us for the Meet the Experts, which is a series of video conferences featuring finance and business experts who are often connected to the Wharton School in some way. While these interviews created specifically for you as a participant of our Global High School Investment Competition are not necessarily designed to give you or your team a competitive advantage, they are a great way to learn from today's professionals and academics about emerging and thought-provoking finance themes like gender lens investing, fintech, global markets, so much more. I'm really looking forward to talking to our guests today, but I also, of course, want to remind you as participants that you don't just have to sit there and listen. I'm sure you have lots of questions, either now about personal finance and our topic today, but you may also have questions arise during the course of our conversation. Please do me a favor and put those questions into the Q&A window right next to the chat window here in our Blue Jeans system. Therefore, we'll pull those questions out. We'll leave plenty of time to get as many questions as we can, but we want your voice to be heard. This is a student program, and your voice is critical. So put those questions in at any time, and once I finish my conversation, I'm happy to grab those questions and share them with our guests. Okay? Excellent. All right, so today we're taking a break from Nicole Jordan's personal financial goals, which you've been working so hard on for the past couple of weeks, to think about how you can develop skills for yourself, and the competition may help you apply to your own financial future. Joining us is Wharton Professor of Finance, Michael Roberts. Dr. Roberts earned his BA in economics from the University of California at San Diego and his master's degree in statistics along with a PhD in economics from the University of California at Berkeley. His primary research is in the areas of banking and corporate finance, and more specifically capital structure, investment policy, payout policy, and security design. He has received several research and teaching awards. Professor Roberts is the co-editor of the Journal of Finance and serves on numerous editorial boards. Professor Roberts, thank you so much for joining us today. Oh, I think we have him muted, so there you go. Still muted, let's get him unmute. Okay, hi, there you are.
Can you hear me now?
Thanks for joining us. I can hear you now.
Excellent, good to be here.
So let's start with a definition. Can you define personal finance for us?
Sure, it's finance applied to the individual or group of individuals, like a family. So some examples might be more constructive than a formal definition. When I hear personal finance, I think about the decision making that individuals have to make that have a financial aspect, such as buying a home, renting an apartment, buying or leasing a car, saving for retirement, et cetera, et cetera, et cetera.
Excellent. Is investing an important part of personal finance?
Absolutely. It's a centerpiece of personal finance in many ways, right? Because if you think about your financial well-being, how you manage your money, i.e. how you choose to invest it, can have a profound impact on your entire life, both before and during retirement.
So at Wharton, we teach corporate finance more often than not, right? So if you came to Wharton as an undergrad, as a freshman or a sophomore, you would take a corporate finance course. What's the difference between corporate finance and personal finance?
Okay, so first, I'll say that the title of that core course, which I've taught for the MBAs and undergrads for on and off for 20 years, is a little bit of a misnomer. It's really an introduction to finance. But so there's personal finance and corporate finance, where the latter refers to how organizations, not just corporations, but really any type of formal organization chooses to finance or fund its operations, its investments, its existence.
Okay. So one of the things in finance is risk. It's a consideration in investing and money management in general. Making risky investments can, for example, make you a lot of money, generate a lot of wealth, or it could also lose you a lot of money if it doesn't work out as planned. In the student's role as a portfolio manager, so in our competition, as we've discussed, is students are acting in the role of managing a team of portfolio managers. They have to weigh certain risks since they are investing someone else's money. Is that different than the choices they would make when they're investing their own money?
Potentially, yes. And that might seem that might have nefarious undertones, right? Wouldn't you expect someone to be as good a steward of someone else's money as you would of their own, or they of their own? But what differentiates people along the risk dimension is their risk tolerance. And so I'll use myself as an example. I'm a relatively risk averse person. I don't like a lot of risk, as evidenced by my choice of profession. I'm an academic. So I tend to be relatively conservative in my decision making, and that certainly applies to a degree in my investment decision making. And that's different than if I was managing someone else's money who was much more risk tolerant. So I would in many ways be doing a client a disservice in imposing my risk preferences onto their investment strategy. If, say, they want to take on more risk, or if they're more risk averse than I am. And so that's how you can get a disconnect or a difference between managing your own money versus managing someone else's money without necessarily doing anything that would be detrimental to your client. Does that make sense?
Okay. Yeah, totally.
Okay.
Let's stay on risk for a second, though. I want to talk a little bit about measuring risk, right? So when making a risky investment, again, we're starting at a pretty basic level, but it goes all the way up. You talk about how you teach a class to undergraduates and MBAs. These are high school students who are very, very savvy. We know our students that participate in this competition are working really hard. What are some tools or instruments they could use to measure risk?
Boy, that's a great question. How long do we have?
Well, exactly. We have a couple of days. No.
Okay.
Some real, and I think, in many ways our students will dig deeper. If you point them in the right direction, I think they'll jump right in on this.
Absolutely. So there's a variety of different ways to measure risk, and it's important to emphasize that we do measure risk. But we never look at risk in isolation. So I want everyone to keep in the back of their mind that while we're talking about different measures of risk, they're really only interpretable in the context of reward, or more specifically return, right? So what's the first place you might start in terms of measuring risk? If I just poll students, which I often do at the start of that module, everyone will say, standard deviation or volatility, same thing in finance, right? How much the stock price bounces around. Does it bounce around a little bit or a lot? The former being less risky than the latter. So that's certainly one way to measure risk. But as we sort of dive deeper and deeper into the bowels of finance, we begin to understand that perspective is somewhat limited and somewhat narrow. And so we start thinking about alternative measures of risk. For example, as a portfolio manager, you might be concerned about the probability of loss. What is the probability of my investment losing money, or the probability of my investment losing money below some benchmark I'm aiming to achieve? And then you think, well, okay, so there's the probability of loss. That's another measure. But we don't just care about our probability of losing money. We also worry about how much we're going to lose money, or how much we might lose if we do lose money. So then we start thinking about things like the expected return conditional on losing money, right? In other words, if I tell you you only have a 1% chance of losing money, you might say, aha, that's a great deal. But if I tell you if you do lose money, you lose all of your savings, that's a slightly different story. So we can't sort of disconnect probability of loss from how much we might lose. Okay, so some other measures. Value at risk. This is something that most regulated institutions, and certainly all banks, are legally required to compute. This is a measure of how much our portfolio can lose over a certain horizon subject to some probability. So there's a 5% chance my portfolio will lose $100 over the next 6 months. That is something called value at risk. And you can change the probability and you can apply it to a bunch of different portfolios, but that's yet another measure of risk. These are all sort of standalone measures of risk. And the last one I want to mention, although, we can keep going for days, but it acknowledges this notion that many investors are diversified. And so if I'm going to look at a stock, an individual stock, or even a bond, whatever asset it may be, I'm actually less concerned about how much it bounces around on its own. That is, how volatile the price is, or the probability of loss of that individual asset. And so what we spend quite a bit of time on teaching students is that when you look at individual assets, you have to look at how they fit into the portfolio as a whole. And once you take that perspective, it turns out that how much the stock price or the asset price is bouncing around becomes much less important. What's important is how that stock price co-varies with your portfolio, your broader portfolio. So the question becomes, if I buy a stock and I bring it into my portfolio, does it tend to do well when the rest of my portfolio does well? If it does, well, that's actually kind of a risky stock because it's not going to help me when my portfolio tanks. If my portfolio tanks, that stock goes down with it. That's quite a bit of risk. Alternatively, if I have a stock that actually does well when my portfolio does poorly, that's going to help me. That's going to sort of smooth out the ripples in my portfolio wealth. And so that stock is actually quite a bit less risky from a covariance perspective. And so when we talk about covariance, I'm really talking about beta risk. And that might be something with which the participants have heard or are familiar with. So, that's several different risk metrics. Again, there are many others, Sorrentino ratio, Trainer ratio, all sorts of risk and risk return metrics. But hopefully that gives sort of a starting point for some people.
I think that's really great. And I think it's actually one of our students, Alexander, had that question about diversifying your portfolio. And in many ways, you're answering that as another reason to diversify your portfolio is to mitigate risk, is that you want to have lots of different options in there, lots of different, whether they're equities or bonds, or in our case is equities and maybe some T-bills in there to really kind of balance yourself out to be able to have the return that you're looking for over a longer period of time. But I want to shift a little bit. I want to shift to another area, another investment that students can make, and a piece that you're making that really ties back to this personal finance that is the theme of our conversation. So you wrote a recent Knowledge at Wharton opinion piece on why finance should be a mandatory for high school students, noting the crisis around student loan debt. Why do you feel that high schools don't teach finance? Why don't they teach it? If it seems like you make a great argument that you need to understand this, you're going to take on loan. And I want to stay on student loans and talk about investing in yourself, because that's really, isn't that what kids are doing? Isn't that what you're doing by taking out a loan?
That's exactly what you're doing. You can, so going back to your first two questions, Eli, personal versus corporate finance, there's no difference in the concepts or tools used for personal finance and corporate finance. They're identical. Yeah. There's only one finance. What differs are the applications. That's it. And so when you talk about student loans as an investment in yourself, that's exactly what it is. Just like a company has to assess, should we spend a whole bunch of money on this project in the hopes of getting future revenue and profits? Well, we're going to look at this through the lens of what we call discounted cash flow analysis to determine if this is a good investment. But you should be doing the exact same thing when you're making personal finance decisions. And it doesn't matter if it's, should I take out a student loan to get an advanced degree or an undergraduate degree versus should I buy this house and finance it with a mortgage? If I do, how much of a mortgage should I take on? Or should I buy a car? Should I lease a car? All of these are just simply investment decisions. And so the motivation for that came in part from something very personal to me, which was, I took out some loans when I went to graduate school. I had no idea what I was doing. Okay. I got very lucky in that my loans were relatively modest in size, and I was fortunate enough to get a good job that allowed me to pay off the loans quickly once I graduated. But when I reflect back on that decision, I really was just lucky. So imagine having a group of teenagers and adolescents who were comfortable and knowledgeable engaging in profound financial decisions that will affect their lives not just today, but in many instances for decades. Now, why schools don't require finance? My understanding is that's changing a little bit, that it's certainly an option to take finance in high school. I don't know how many mandate it. But when I think about the relevance of, say, trigonometry, with all due respect to trigonometry, versus finance, is there really a discussion to be? I mean, does it really require a debate in terms of the relative importance of the two for life skills? And I don't think so. So my hope was to sort of pile on to what I believe is a general understanding that people recognize finance is important, and it's important from a relatively early age. So we need to get kids knowledgeable and engaged in those financial decisions as early as possible.
That's excellent. So it's 24 states is the current number that require some sort of personal finance course. Now, how they define personal finance and what's covered is as varied as those 24. But that's not even halfway. I mean, so that's just the United States, and as you know, we have a global competition. So outside the United States, we don't have those numbers. I haven't seen those numbers as to what countries required on a national level and the like. But very interesting to think about. No difference between personal finance and corporate finance. It's just finance, and you're investing in yourself as your own corporation.
That's it. I have a balance sheet. You have a balance sheet.
Yep.
We may not write it down and file it with the SEC, but we all have personal balance sheets, right? We have some assets. I own a home. I've got some savings, but I borrowed money to finance the home. That's my balance sheet. And so I also have an income statement. I work and I get paid, and I have to spend money. I have to pay taxes. And at the end of the day, at the end of the month, I've got some money left over that I can invest. That's my equity. So, the tools, that's the beauty of finance. It's such a small set of tools and concepts that if you can just get a firm grasp of these fundamental ideas, the applications are relatively straightforward.
So let's talk about that a little bit. That's a great transition to my next question. High school students who are competing with us, they're going to emerge with some skills, right? If they spend time in this competition, they spend the 10 weeks competing, writing their report, they're going to understand some key financial concepts like risk and reward, portfolio diversity. We talked about both those things, right? How to closely analyze companies. How can they take what they learn from this, right? Again, you saying no difference between corporate finance and personal finance, and how can they do this to address and leverage toward their own personal goals? Where do they go from here to start their own money management? Now they'll start managing, in theory, when they generate some revenue themselves, their own investments.
Yeah. So the first thing I have all of my students do in my courses is I have them construct a retirement savings plan. And a central component, the pieces of that plan, begin with, setting up a budget, based on my income forecast over my working years. What are my planned expenses, my tax liability, how much can I save each period? Then, what am I going to be left with in terms of a nest egg at the start of retirement, and how am I going to consume in retirement? So they do the whole thing. But at the center of that strategy is their investment strategy. When you save money, you have an investment strategy. You're investing it. And so by getting comfortable with managing money, whether it's your own or someone else's, you are really setting yourself up for success in two ways. First and foremost, you're gaining comfort with risk because you're exposed to it. You understand that investments and asset prices move, they're volatile. So you can avoid sort of behavioral errors in terms of, selling low and buying high. Right? We don't want to do that. So you're gaining comfort, you're gaining experience. In terms of managing your own money for the benefit of your entire life, both while you're working, should you happen to have a liquidity need or some type of shock where you need money, you will have savings, as well as for the benefit of when you're in retirement. one of the biggest fears, and so speaking as someone who's actually approaching retirement, hopefully not too soon, one of the biggest fears is outliving your money. And so making sure you are established with a sufficiently large nest egg that is appropriately invested while you're in retirement is just critical to peace of mind and general health, psychological and physical health. So what these students are doing now by managing money and thinking about investments carries over directly, one for one, with their personal finance outlook.
Is it too soon for them to start thinking about retirement?
No, it's not soon enough.
Not soon enough. As soon as you start generating some money, though.
That's it. I don't, it's funny. It's very easy to say, well, okay, what am I going to do with 10, 20, $30? The power of compounding is such that just socking away a little bit of money consistently over 50 years is it's just amazing how large that money can grow. And so I also have students, when they look at their retirement saving strategies, I say, okay, imagine you save for 40 years, right out of undergrad, from 22 all the way up to 62 when you might retire. Now let's see what happens, how that nest egg you're left with changes. If you only start retiring when you're 32, you live it up during your 20s, you just spend like a fiend, no savings, and you only get serious maybe when you're in your 30s after you've gotten married, whatever it may be. And the difference in the size of that nest egg is just, in some instances, orders of magnitude. It has a huge impact on how well you're going to live in your retirement years when you really need that money because you don't have any more earning power. That's it.
Yep. The compound interest is fascinating. So in your article about student loans, you talk about compound interest the other way.
Yeah.
That the money sits in it, right? And then therefore it's going to cost you more to pay this off, when in fact it could also work in your favor if you put it away. So we have a great question, a specific question from students about bonds actually. And the question of what's your opinion about bonds actually with global inflation? Do you think bonds are now an attractive allocation? We're focusing again on the competition on equities and treasury bills, but this question of bonds is a good one. I think it's something that even for an advanced high school kid to start thinking about bonds is pretty advanced.
Yeah. So it's a great question. Look, low interest rates mean really high prices on bonds. That's it. So that's the way to think about it. Bonds are very expensive in some loose sense. And so the question is, how do they look in terms of both the current high inflation environment? Obviously, nominal bonds like treasuries, they don't look very good. You're losing money in real terms, right? You're earning 1.6% on the long end of the yield curve, something around that, certainly under 2%. But if inflation's running at 4 or 5%, right, that's approximately negative 2-3% per year on your money. So they don't look great, that's for sure. Now, there are alternatives such as inflation indexed bonds. Can give you some sort of a hedge or insurance against inflation risk. That's an option. There are also alternatives to bonds if you're willing to take on a little bit more risk. Bonds that are floating rate, so to hedge out any sort of concerns about increases in future interest rates, right? If we have inflation, we're really concerned about the Fed starting to jack up rates if the economy starts overheating. In which case, if you're sitting in at a fixed rate on a bond, you've got problems when that rate starts going up because the price of your bond is going to start going down. So there are alternatives in the fixed income space in terms of floating rate bonds, in terms of inflation protected bonds, and there are options in terms of risk, right? So you can invest in investment grade bonds that offer relatively safe but low yielding returns, or you can move into high yield speculative grade bonds that offer higher returns but commensurate with their higher risk. So I know you guys are focusing just on equities, but that's not to say that bonds are bad investments or unattractive, even in low interest rate environments, because one could just as easily turn around and say, hey, you know what? The stock market's overvalued right now. Now, is it? I don't know, but if I did, I wouldn't tell you.
All right, one last question, because I get this from high school students all the time when I'm teaching a class, especially an intro personal finance course. Why in finance, and I've wanted to ask a finance professor this for a long time, why in finance do they use different words for the same thing?
Okay, great question.
Oh no, that was I don't know.
Okay. So every time I start a class, I say the biggest hurdle to learning finance is arguably the language. The
Yeah.
math is easy. It really is. Yes, it can get very complicated in some esoteric fields, but the way I teach the core finance, if you understand arithmetic, you're fine. Okay. So what makes it hard is this lingo. All the acronyms we have, all the right multiple words for the same thing. Okay. Why do we do it? One part of it is it's a language, and it's a language in different parts of finance. Fixed income refers to certain concepts with their language, whereas equities or corporate finance or derivatives might refer to it the same concept with a very different term. Okay, so there are pockets within finance. It's not just one homogeneous field. But I think another reason, whether it's intentional or not, is as a barrier to entry, right?
Hmm.
Right. There's a great way to keep non-finance people out of finance, and that's just to start speaking finance, right? I start talking about, the current swap curve, and people just go, "Boop, okay, what are you talking about?" Or, what CDS spreads are at. People just check out and they leave me alone. All right. But I think rather than focusing on the language, which is useful from a communication standpoint, but only so much, I think far more useful is sort of empowerment in the knowledge of the principles of finance, so that when someone does start throwing lingo at you, you can just say, "Stop. What do you mean?" And by the way, I do it all the time on private engagements, because every company I've ever worked with, they have their own internal financial lingo that's different from another company. So I don't hesitate to say, what do you mean by non-GAAP adjusted EBITDA? How are you measuring that, for example? And people are usually, very quick to say, "Oh, this is what the adjustment means," or "This is what I'm talking about." Sometimes they say, "I don't know," which is interesting.
That's great. Thank you so much. I'm mindful of the time. We had some great conversations, some great answers. Personal finance, an amazing field. We want more and more students to think about. Don't be intimidated by the language. Don't be intimidated by the math. We have great resources for you. We're glad you're all competing in our competition, able to dip your toes into this water with us. Michael, thank you so much for joining us today. We really appreciate it. I just want to let everyone know that the Meet the Experts event will continue. We'll continue talking on next Tuesday, November 9th. Actually, not next Tuesday, the Tuesday 2 weeks from now. We'll be talking to Wharton Professor of Economics, Ete Goldstein. Professor Goldstein will be discussing the stock market and the economy. I hope you enjoyed today's conversation. On behalf of our whole high school investment team and everyone here at the Wharton School, thank you guys so much for tuning in. We appreciate it. We will see you all soon. Thanks, everybody.
Thank you, everyone. Stay well.